Hello guys, welcome back to lesson 15 of module 1 of our course, Introduction to Algorithmic Trading. So today we're going to talk about three different types of order blocks. We're going to talk about vacuum blocks, we're going to talk about reclaimed blocks, and we're also going to talk about propulsion blocks. Alright, so let's define what a vacuum block is. Now, we already know the basics of what an order block is. It is a block in price where there was provision of liquidity by central banks to institutions, and it can be confirmed with displacement, aka institutional sponsorship. Now, with a vacuum block, when we have in this example here that you can see, this is a bearish order block. All right, so we have an up candle, and then we have displacement in price. But now, if you notice the displacement, we have a displacement with a gap, with an actual market gap, meaning there's a void in price. Okay, so when this candle closes up here, the next candle opens down here and then trades lower. Now, usually when you see price like this, that indicates an aggressive willingness by the algo to reprice a level of sell side. Again, this is a bearish order block, so we're looking for sell side as strong liquidity. Now, that sell side could be in form of a inefficiency or sell side liquidity pool. And then obviously you reverse the idea for a bullish order block. Now, the difference between a vacuum block and a classic bearish order block is that a classic bearish order block has displacement but doesn't have the gap in that displacement. But with a vacuum block, we have a displacement in price that has a liquidity void. Okay, so the next candle, there's a void in price created and just displacement, and that oftentimes indicates that there's an aggressive. Like it's different from the classic bearish order block in that this one has an aggressive willingness to want to trade down to a level where there will be counterparty transactions. And we're going to use an example here, and you can see a chart of British pound futures from this is Friday, 2 weeks ago. All right, so we have a very clear general liquidity. You can see obviously order flow is bearish. We're constantly run our sell side, and we're failing to run buy side, especially when we have run a buy stops. Now remember, if we are in a bearish order flow, whenever we run a short-term high, that's not a breaking structure. Instead, from what I taught you guys with on the lesson on institutional sponsorship, okay, whenever we run a short-term high in a bearish order flow, that is not a breaking structure. Instead, that's a run to reaccumulate new shorts against retail pending longs. And you can see every time we run a short-term high, you see willingness in price to want to displace. And then every time we run a short-term high, you can see willingness in price to want to displace. And every time we run a short-term high, you can see willingness in price to want to displace again. Okay, and here on pound, we have a run lower and then price retraces. But now watch the delivery lower. So after we created this up candle, okay, from this old trading range, we have the next candle create a gap, and then the next candle create a gap and trades lower. Now what I teach is whenever you see a candle like this with barely any bodies, when there's no bodies in that candle, I usually ignore the candle and go to the next candle, which is this. So we have a up candle, and then we have a bearish candle, and then the next candle follows through with a gap. Okay, now unlike the example which I indicated here, whereby the next bearish candle just open up with a gap and trade lower, here it was the third candle. I'm not looking at this one. Okay, this candle opens up with a gap. It's still the same thing, okay, because this bearish candle has not really left the range of this up candle. It's still inside the range of this up candle. But the moment we leave the range of this up candle, you can see that aggressive displacement down there. So if we return back up there in the future, we should see sensitivity in price there, just like we would from a classic bearish order block. Okay, so you can see after we make a short-term low, and then we start to retrace back up into the bearish order block, you can see that our rejection block is our sell side liquidity objective, and price trades up there into our vacuum block, no price action there. We have a liquidity void there, and trades up into the vacuum block, and you can see we have displacement. So this is how you will use a vacuum block for your idea. Now remember, you have to build a directional premise first by understanding where drawn liquidity is. Once you can understand where drawn liquidity is, then you can go into the marketplace to build a narrative. So all of this is just narrative building. Okay, knowing where and when to enter, and knowing where and when to exit from your idea. All right, so that was really straightforward for vacuum block, and we're gonna go into reclaimed blocks in price. All right, so what are reclaimed blocks? Reclaimed blocks are simply order blocks which looks like the market has traded through them, but they are still valid. So what you can see here is, you can see we have a short-term high here, price is trading higher from a level of discount, trades up into a premium, we create a short-term high. You have a last up candle, you can see just displacement in price, and price trades lower. Now classically, what we would expect is, we would expect price to trade up into the bearish block and then see displacement. But in this example, price trades through and runs for the buy side liquidity pool above the short-term high, and then displaces lower. Now, what would make you think that this order block is still valid? Remember the previous lesson we did on divergence? So if we see this asset running above a short-term bearish order block, okay, making a short-term higher high, we want to say correlated asset make a lower high. That would indicate divergence. Remember, divergence simply is a tool for confirmation of delivery. So if we have a bias and our pre-anticipated bias is bearish, and let's assume that we're shorting this bearish order block, and we short this bearish order block and then get stopped out on the spike above the short-term high, and then we see price trade back below. All we need to do is we need to compare against a correlated asset, and if that correlated asset has seen price run above, price not running above its equivalent short-term high, okay, so you have a short-term high on the correlated asset. So let's say, for example, this is cable, and cable is running higher, but euro dollar is running lower. It's making a high and then a lower high. Okay, then we obviously know that this run higher was a stop run. So what we can do is we can use this old bearish order block, which is still going to be valid again, because that was an old era of institutional selling. So when price trades back down below, institutions will still reaccumulate short, and then the algo go into distribution mode or profit release phase. So when this candle trades on the closing basis below the bearish order block, we can short the retest back into the sensitive points of the candle, which is going to be the open and the main threshold. Now if we had a wick down here, then we can also use the wick, which is no wick in this candle. So we're going to use the opening price of this bearish order block and then the main threshold as our entry, and our stop goes above the order block, because that becomes a reclaimed order block. So it looks like it becomes invalid because price is traded through, but if that was a stop run confirmed by divergence with a correlated asset, then we can use that reclaimed block to get in sync with order flow and ride prices lower to our target objective. And we're going to use a example here. All right, so what we're going to do first off is we're going to break this down from the higher time frame to lower time frame. So you can see here we ran below the short-term low here, and displacement in price, breaking structure, displacement. We have a discount array down here. And that discount is in form of a balance price range. Okay, so we have a daily balance price range there. And you can see price trades down into that daily balance price range, and we can see displacement away from there. And we have a short-term drawn liquidity on daily time frame, these clean candlestick bodies, that's a rejection block there. So that's our daily buy side liquidity pool. And we don't need price to trade up there for us to make money. Okay, we just need to know where price is going to, and we can ride on the lower time frame a portion of that move. All right, so now we go to forward time frame, and we continue the narrative from the forward time frame. So what we're looking for is we're looking for this far bear shoulder block as our general liquidity, because that's where we have that daily rejection block. Now on the far time frame, we have a run on the short-term low inside the discount, which is a BISI. Okay, so let's take the range of the BISI from that to that, and remember the rules with our buy side and bounce and efficiencies, which is different from a fair value gap. Okay, it's more likely to trade down to constant encouragement than to see a complete fill of a buy side and bounce and efficiency. We have a short-term breaking structure here. Market runs with a short-term low, and if you go back to 2 lessons ago, I taught you guys that whenever you see a run on sell stop in a bullish order flow or in a pre-anticipated bullish order flow, that is your strongest confirmation of displacement. Okay, so you can tell pressure style time from level and institution sponsorship indicated by displacement away from there, and then we're back into a 1 hour bear shoulder block and also the consequent encouragement of a 4 hour buy side and bounce and efficiency. Now if you look closely here, you can see we have a bear shoulder block. This is the candle that starts the impulse leg higher, so that's our bull shoulder block. Now you will look at this and you would think that it's invalid because we've seen price trade through here, and it also looks like price trade through here, but it's not. Okay, going back into the reclaimed block. Okay, so with USJPY, if we compare and see what dollar is doing, dollar again, it's not necessary. We already know where general liquidity is, but we're looking to see if there's confirmation on dollar. And you can see while dollar is running lower, USDJPY is running higher. Okay, that's your SMT divergence right there. Now you're gonna look at this and say, but this is running lower, it's not running higher. Well, what you're not taking into consideration is you're looking at the wicks, not the closure, so the bodies of the candle. Remember, the bodies of the candle is where we have the bulk of liquidity traded at. So if we switch over to a line chart, just like we're doing for dollar, and the blue line chart is that of USDJPY, okay, which is a correlated asset against dollar, and the orange line chart is that of dollar, you can see that USDJPY is running higher, dollar is running lower. So we have underlying strength in support of USDJPY. So I'm going to go back to the candlestick. I'm going to eliminate that. So we know that this run lower is just simply a run on stops, and it's not, does not necessarily invalidate the order block. Now, as we've seen this happen, okay, as we've seen price run lower below the order block, once it trades back above the order block during an active session. Now look at the pair we're trading, US dollar and Japanese yen. Okay, so if we are trading Japanese yen, what kill zone is going to be more sensitive for this price, for this asset we're trading? Asian session. Why? Because the yen is most actively traded during Asia. So your kill zone changes from just London and New York or London close to the Asian now, because you have the yen pair that you're trading on. Okay, so let's define the start of Asian session. Let's see the time here, and this is the 20th of March. So Asia starts here and Asia ends here. Start of Asia session, end of Asia session. Okay, alright, so the price is still inside and we get displacement. Now we can go into the marketplace and go long. We have the support of daily impulse like higher, run on sell stop, return back down into discount, 4-hour confluence with 1-hour bullshit block. Drone liquidity is up here. We have an entire sell side imbalance to completely close on, and then we have a lower resistance the current run. Okay, equalize up here, which we will look at as classic resistance. So we have all the confluence of a very good trade setup here. And I think we possibly might have missed our entry from here. I don't think we had any entry here. So it got very close to the entry. Let's actually go to the lower time frame. Oh, okay. Actually, if we went on the lower time frame, that's a 15-minute time frame. So you can see 1, 2, 3, 4 down candles prior to displacement. So collectively, they make up the bullish order block. So that's a 2R. Sorry, that's a 1R bullish order block. Okay. And prior to the Asian session, we trade down there. We see displacement away from there. We trade down into the bearish order block. Sorry, bullish order block. And then we see an impulse leg higher. So again, we don't need to see pressure back down there again. So we're gonna use institutional entry drill, and we're gonna buy, and our stop goes below. This is a BISI, so our stop goes below the BISI, or you can put your stop below the order block, and you can aim for target objective. Okay. And I'm sure you guys will have the question, why would I not expect price to trade down back there? Because you can see that we're inside an active session and we've seen displacement. So during that session, we're looking for the profit release phase, meaning we're looking for price to expand to the liquidity pool. Okay, so price is not gonna trade back down here again after the expansion has already started, and that's why we aggressively run for the buy side liquidity. So this was a reclaimed bullish order block here. Okay, you can see how initially trade down there, we'll see displacement, trade down there. It looks very muddy, and you guys will be wondering why this is so muddy. I don't understand what's going on, and I'm explaining what's going on. All of this is just simply institutional reaccumulation inside a bullish order block, and you can see that indicated here. Once it's an active session, Asia starts to see the displacement in price, so you can absolutely time displacements when they are supposed to occur in price. And then finally, we're going to cover propulsion blocks. I think I've talked about propulsion blocks a lot. I do talk about propulsion blocks a lot, but we're going to cover this officially on the course. So let's define what a propulsion block is. Let's use an actual example in price. I'd like to use an actual example for what a propulsion block is in price. So let's see if we can find one on the daily time frame, because I don't want to have to go and start drawing stuff. Looking for a propulsion block in price. I want to look for a very classic one. I don't want to use a little bit more complex propulsion block, so it's easier to communicate the idea, and then on the live session we can build upon. But USD JPY's price action is so muddy. It is so muddy. Let's see if we can find. Okay, I think we can see one here. So this is from Thursday on Aussie. So you remember Thursday on Aussie during the live session, I told you guys that Aussie's going up here, and that's the objective. You can go back and watch the recording from the live session during New York when we're calling for this objective up here on Aussie, and we actually met that objective on that pair. Alright, so now what we have here is we have a bullshit block, okay, inside a fair value gap. So let me just identify the fair value gap real quick. So we have a bullish fair value gap, okay, and I want to make sure the color scheme is perfect. So we have a bullish fair value gap here, price trades down there, displacement, and then this candle trades down back there again, and you can see we see expansion. Now propulsion block, the name comes the name rhymes with the concept propulsion, Okay, think about jet propulsion engines. Okay, what do they do? Speed, right? The quickness and delivery. So that's what is classic about propulsion block. It usually indicates that there's about to be speed of delivery. Now let me explain the logic behind propulsion blocks. I think I might have explained this before, but we're gonna touch on this again. Okay, so what's the logic behind propulsion blocks? Now, if you remember, institutions cannot efficiently accumulate at one price point. They have to do so gradually. Think about an elephant going into the pool. If an elephant wants to go into the pool and do it so subtly, it has to go in one step at a time. So it's going to go into the pool, one feet in the water or the pool, second feet in the water or the pool, okay? And every time the elephant puts a foot in the pool, the water rises, but it's not so drastically. And then by the time the elephant is entirely in the pool, then you see the pool start to overflow because its weight displaces the water. That's the same thing with institutional accumulation or distribution. So when we have a bare shuttle, so I'm going to use a bare shuttle block example here. Okay, so when we have a bare shuttle block in price and price trades higher, what's going on there? Again, this bare shuttle block has to come at a premium. Okay, so we're looking for a premium, and that would indicate that there's institutional participation there. Now, when we see the bear shuttle block, we obviously that is followed by displacement in price. Okay, and we get the displacement in price. Now, a lot of times, price will return back into that bearish order block. So let's we're gonna have to draw this. Okay, and then we go up there, and price trades up into the bearish order block, and then starts to trade away from the bearish order block. Then what happens is you get this. Alright, you get another bearish order block into a bearish order block. Now, what we expect from here is when we, as long as we can identify atrial liquidity on the sell side, because in this example we're looking at a bearish order block, what we expect to see is something like this. Okay. That's what we expect to see. The reason why this happens is because when institutions are selling short here, when the market is returning back up there, it's giving institutions another chance to reaccumulate more shorts. And then what happens next is the algo goes into profit release phase because all the accumulation of shorts is already done. So it has to quickly run for counterparty liquidity. That's why you see that classic speed price action. So a propulsion block is a order block that trades into a previous order block. That's a propulsion block. So in this example, we have a bearish order block from, let's say we have a reversal from an uptrend. So the propulsion block is this candle here, which trades into a bearish order block. So you could sell short anticipating the formation of a propulsion block, or you could sell short the moment price trades below the low of this candle or this. So we have two consecutive up close candles which collectively are propulsion blocks, so you can sell short a retest back into the propulsion block here. Okay, so two candles, that's collectively propulsion block. And our rule with propulsion block is we never want to see price close above the mean threshold of the propulsion block. So the mean threshold of a propulsion block is measured by taking into factor the bodies of the candle. We're not concerned with the wicks. So we have two up candles here, so we're going to measure Fibonacci from high to low, and our mean threshold is the 50% of the range of the consecutive up close candles that traded up into the previous order block, that's the main threshold of our propulsion block. We never at any point want to see price trade above our propulsion block, the main threshold, because of the speed of delivery. Okay, if it trades on a closing basis through, again, we're not concerned about the wicks. It could spike up with the wicks. We don't care. Okay, what we don't want to see is we don't want to see candlestick body closures above the main threshold. Okay, because if we see that, that does not indicate that aggressive willingness in price to want to displace. Let me give an example. If you drove a Bugatti, okay, and you put your foot on the gas and you change gears and you drove a Bugatti, do you expect to go 30 miles an hour? No, you're expecting to go over 100 miles an hour on a Bugatti. Why? Because it is a Bugatti. That's what it's supposed to do. Now, if you drove a Toyota 2003 or, yeah, let's say Toyota 2003 car, let's say 2003 Camry, are you going to expect it to go 100 miles an hour once you step your foot on the gas? Of course not, because it's not designed to do so. That's the same thing with the propulsion block. Its design is for efficiency of distribution. So it's trained back up into an old level of previous distribution to allow for more institutional distribution. Once it's done that, the algo has to kick into proper release phase and aggressively distribute liquidity to where there's pending counterparty liquidity that these institutions or accumulating shorts here can offset distribute their positions. So if we don't see that willingness in price to aggressively distribute, then that indicates that either our narrative is wrong or something is going on fundamentally. Probably there's an economic release on the horizon and price is going to hold price until that release. Multiple factors can be in play, but we don't want to see price trade through the main threshold of a propulsion block. Alright, so I think this is starting to be a very long lesson. Hopefully this has been impactful and insightful to you guys all. And on the next lesson, we're going to start off with module 2, higher time frame trading and fundamentals. With that being said, I wish you guys all happy trading and trade safe.